Gold is usually looked upon as a safe haven investment in times of crisis. So what about this crisis? Will gold shine again as a result of COVID-19? Well, that depends on your time frame. There will be a time for gold to shine, when the worst of this pandemic is over, when the impact of all this fiscal and monetary stimulus shows up in higher inflation. But that's for later. For now, gold is likely to trade positively correlated to the US stock market and inversely or negatively correlated to the US dollar. So if we get another round of weakness in stock prices, we are likely to see a stronger US dollar and a weaker price for gold. Since the early 1970s, when gold became freely tradable in the United States, the big cycles in the price of gold have generally been inverse to those for the trade-weighted US dollar index, the DXY. Meaning, as the trade-weighted value of the US dollar rises, gold tends to weaken, and vice versa. One problem facing gold in the midst of this pandemic is the sudden shutdown of businesses and the sharp drop in cash flows. Companies have found themselves competing for access to US dollars to pay for things like fixed overhead expenses, loan commitments, and that will likely keep the US dollar strong. Now, here's another hurdle facing gold. Pandemics are deflationary. They destroy current demand by shutting people in and putting them out of work. So no incomes and very little consumption. It also destroys future demand by drawing down the bank accounts of individuals, diminishing the reserves of companies, blowing out government debt. And all of this is deflationary. In general, gold does better in an inflationary environment than in deflation. For example, when the inflation rate in the US took off from 1973, the price of gold surged 3.6 times between end 1974 and September 1980. But when US interest rates went up to 20% by 1981, the result was recession and disinflation. The price of gold fell 56% in the 5 years from early 1980. But gold really took off again in the period 2009 to 2011 as the market started anticipating rising inflation rates from quantitative easing in the wake of the global financial crisis. And that will probably happen again when we are past the worst of COVID-19 and the market starts anticipating inflation again, when the market starts worrying about the extreme stimulus being applied by governments and central banks all around the world. But that's a longer-term story. As always, I wish you good luck in the markets and stay well.